Today, Kiwis see another rate cut as the Reserve Bank of New Zealand takes a different path. Hello again, it's Martin North from Digital Finance Analysis, one that is post covering finance and property news. I want to underscore the differences between New Zealand and Australia with regard to monetary policy. Of course, New Zealand acted early to lift rates, took them a lot higher, and now they are in cutting mode. The Reserve Bank's Monetary Policy Committee lowered the official cash rate to 4.25% from 4.75%.
Policy Committee agreed to reduce the official cash rate by 50 basis points to 4.25%. Annual consumer price inflation has declined and is now close to the midpoint of the committee's 1 to 3% target range. Inflation expectations are also close to target, and core inflation is converging on the midpoint. So it's a very positive position for the committee to be in. If economic conditions continue to evolve, as we outline in our document, as projected, the committee expects to be able to lower the OCR further in the new year. In fact, early next year. Economic activity in New Zealand remains subdued and output continues to be below its potential. With excess productive capacity in the economy, inflation pressures have eased. Domestic price and wage setting behaviours are becoming consistent, with inflation remaining near the midpoint of our target range. And the price of imports has fallen, also contributing to lower headline inflation. Looking forward, economic growth is expected to recover during 2025 as lower interest rates encourage investment and other spending. Employment growth, however, is expected to remain weak until at least mid-2025, and for some, financial stress will take time to ease. And this is the usual lag between activity, employment and financial well-being. Global economic growth is expected to remain subdued in the near term, and geopolitical tensions and conditions and general policy uncertainty could contribute to economic and inflation volatility over the medium term. The Monetary Policy Committee agreed that having consumer price inflation close to the midpoint of its target band puts us in the best position to respond to any shocks to inflation looking forward.
It's the second straight cut of 50 basis points as the Reserve Bank seeks to revive the economy now that inflation is under control. So they lifted higher, squashed the economy, but they're now coming out of the other side. In Australia, of course, we're not doing that. Rates are still high, inflation is still above target, and the outlook for next year and the year after is pretty grim. And New Zealand's central bank chief, Adrian Orr, said that a third large cut in interest rates could be delivered early next year if the economy evolves as expected. And that's after easing policy by 0.5 percentage point today. The bank's updated projections are consistent with another 50 basis point reduction at its next decision on February the 19th, Adrian Orr said in the press conference. But it's also conditional on economic projections panning out, he said. The Reserve Bank of New Zealand has now lowered rates by 125 basis points in little more than 3 months, making it one of the most aggressive cutters among its Western peers. Its new forecasts show the average cash rate falling to 3.83% by the middle of next year, suggesting it may eventually move to more gradual cuts. And of course, the old question is, where is that neutral rate? The speed and extent of easing will be highly data dependent, said Sharon Zollner, chief New Zealand economist at ANZ Bank in Auckland. The odds of a 50 basis point cut in February have lifted, given the governor's comments, but the data between now and then will carry the day, and there are clear signs of a broad-based lift in activity. The New Zealand dollar jumped after the rate decision, going up almost half a US cent as traders saw less chance of further aggressive easings, but then trimmed those gains after Orr's comments. The Reserve Bank of New Zealand reiterated expectations that the economy contracted in the third quarter of 2024, putting the nation back into recession for the second time in less than 2 years. And it seems a pickup ahead as lowering borrowing costs revive demand. Annual growth will recover to 2.3% in the year through to March 2026, from just 0.5% in the year ending March 2025, according to the latest Reserve Bank New Zealand forecast. Economic growth is expected to recover during 2025 as lower interest rates encourage investment and other spending. The bank said employment growth is expected to remain weak until middle of 2025, and for some, financial stress will take time to ease. The Reserve Bank of New Zealand's forecasts show inflation slowing from 2.2% currently to 2% the next year, but then picking up again and remaining above 2% through to early 2027. Of course, it aims for the 2% midpoint of its 1 to 3% target range. While domestic price setting behaviour is now more in line with the committee's inflation objective, members discussed uncertainty about the persistence of some components of inflation. Cough, cough. Trump, of course, and trade will be big on the agenda. Policymakers in Canada and Sweden have also lowered their benchmark rates by around 125 basis points, although both those nations started their easing cycles earlier than the Reserve Bank of New Zealand. The Federal Reserve and the European Central Bank have moved their targets down by 75 basis points so far this cycle, while the Reserve Bank of Australia has yet to move, but of course the RBA didn't lift rates at all to those levels earlier on. 4.35% is still the rate, and they're not really expecting to see inflation come back into band until 2026 in Australia, so don't expect rate cuts in Australia anytime soon. There is no doubt that the Reserve Bank of New Zealand will continue to cut rates to fertilise a nascent economic recovery, said Doug Steele, senior economist at Bank of New Zealand in Wellington. The direction of travel of policymakers remains clear enough. Removing restraint, he said, but how fast and how far remains to be seen. The New Zealand Central Bank's latest projections imply it will slow the pace of easing and will likely incorporate pulses into the cycle after a third straight half-point cut. In February, the Assistant Governor Karen Silk said there could be pauses built in, but it is definitely a slower track after February. With inflation projected to pick up to 2.5% next year, monetary policy needs to remain mildly restrictive to keep some pressure on price setting, she said. The central bank is still trying to dampen inflation and price setting behaviour, she said, adding its projections show the cash rate falling to a neutral level but not below, as policymakers currently see no need to stimulate the economy. I would say that we're getting close to the long-term neutral rate by the end of the forecast period, Silk said. By the end of 2025, we might be getting a little bit closer to where we might see the short-term neutral rate today. It's not showing that we could go at any point on the curve below neutral. The Reserve Bank of New Zealand projects the cash rate will drop to around 3.5% by the end of next year and to about 3% by the fourth quarter of 2027, the end of the forecast period. Investors see the cash rate dropping to 3.25% in October next year, and not any further. That's according to swaps data.
We're starting to see some signs of life in the housing market. What's your projection for house prices?
Wonderful. You must be from TV1. The first thing, so we part of the pain of trying to predict the future is house prices are such an important asset. We look and talk about what we think is happening to the value of that asset. And so in our projections, we have, with even a bigger health warning around accuracy than GDP, we have about a 7% nominal growth rate in house prices. For each calendar year, Rebecca? Yep. Now, most people will be really excited about that. Relative to our history, that sounds insipid. Sitting here, why 7% and why not back to 20%, or where we like to see it? Because of our starting point. Our starting point is one where house prices are already at the top end of anything we model as sustainable. I think, I don't have to explain that to too many people. The other part is household indebtedness is still high. And although interest rates are coming back, they are still high relative to some of the historical rates that new borrowers have been used to. We've also got our loan-to-value ratio, and we've got a new debt-to-income tool in there as well. That will constrain some of the frothiness that we saw in lending and the FOMO behaviour going on into the last house price cycle. So, I think it's a nice steady story, but we stand ready to be surprised.
The other thing just over the next 12 months, and Adrian referred to it earlier, is that lag that you have in the labour market relative to increasing activity in the economy, and that goes to confidence. And so until we start to see those improvements in that area as well, you just won't see the same level of confidence to invest more.
Really important point. Employment is no longer the constraint on businesses, or finding labour is no longer a constraint. So that makes it a different bargaining position from there.
The bank's 125 basis points of easing in the past 3 months is one of the most aggressive rate cutting series in the Western world. But Silk says the pace was not a reflection of any internal concerns that the Reserve Bank of New Zealand may have about over tightening. We've got the ability to unwind at a pace that we have in part because tradables inflation have fallen more quickly than we originally thought that it would, she said. And that negative output gap that exists today, that spare capacity in the economy, is doing the job. Asked if monetary policy ideally should move more gradually in order to smooth the business cycle and avoid booms and busts, Silk agreed but said, we have not been experiencing a normal business cycle. No one could call COVID and the things that have happened externally that have had flow-on impacts into New Zealand a normal business cycle, she said. Think about the rapid pace that we've had to go on the way up as well. However, Silk said there was no case for the bank to have cut by 75 basis points. Possibly markets had been given some credence to them doing that. Such a move would imply the bank was seeing a significant shock, Silk said. So, you can see here from the press conference and the questions that were asked that there is general agreement that the Reserve Bank of New Zealand has done the right thing. Things are going in the right direction now, although it's been painful with the recession, and unemployment is still higher than they would want to see, but the trajectory ahead is much clearer. Now, of course, there are some shadows in the background here. What happens if Trump does something significant with regard to trade and puts pressure on international interest rates and therefore pressure on the New Zealand economy? We'll have to wait and see about that. But I have to say, comparing Australia to New Zealand, it does feel to me as though New Zealand knows what it's doing. I'm less sure about Australia. Of course, the RBA is trying to preserve the employment gains, and they are sort of successful, but in so doing, they're muddling through, keeping rates lower and therefore higher for longer, and that higher for longer period will put and continues to put more pressure on households and businesses. Sometimes a short, sharp shock is better than a long, slow grind into, well, we're not sure where. I'm Martin North from Digital Finance Analytics. Thanks for watching, and I'll see you again next time.